In this lecture, we are going to talk about an extremely crucial topic as far as stocks and shares are concerned. So first of all, what are stocks? Stocks are the ownership of a small piece of a company. This entitles the owner of the stock to a proportion of the corporation's asset and profits equal to how much stock they own. By the way, shares are the units of stocks, so this is why shares have become the synonym for stocks. Okay, so what's extremely crucial that stocks represent the ownership of a small piece of a company. Which means that if you have a good idea, for example, you would like to develop a software, an application, whatever, then you can raise capital by selling off future profits in the form of shares. So for example, let's assume that you have an extremely good idea, but unfortunately you don't have enough money, you don't have enough capital to hire software engineers, to hire digital marketers, to hire managers and so on. So one option is to raise capital by selling of future profits in the form of shares. And by the way, this is how small companies and startups begin usually. So the investor or the shareholder gives you cash. In return, he or she gets a contract stating how much of the company he owns. And of course, you may pose the question that why is it good for the investor? Let's assume that you are able to invest into Facebook when it started 20 years ago. Of course, it would be an extremely good idea to invest in Facebook because Facebook has become the #1 social media platform in the past 10 years, so the investor or the shareholder would make a lot of money with this investment. So this is why it is a good idea in order to raise capital, and this is why it is good for the investor. Okay, first of all, let's talk about the ecosystem as far as stocks, investors, stock exchange, broker firms are concerned. So first of all, there are the companies that want to grow their businesses and want to raise capital. Of course, a straightforward way is to borrow money from a bank, but it is sometimes too expensive. So another solution is to go public, which means that investors may buy the shares and stocks of the underlying company. But what's extremely crucial that investors are not able to contact these companies directly, because of course it would be too complicated for every single investor to contact every single company. Maybe the investor is not interested in the given company, so he or she has to contact another company and so on. So this is why stock exchanges came to be. So the stock exchange has the list of all the available companies that want to raise capital. So basically the stock exchange brings together the buyers and the sellers. Of course, the companies try to sell their stocks and the investors may be interested in buying the underlying stocks. So what's crucial that the stock exchange has the list of all the companies. There are several stock exchanges such as the New York Stock Exchange. It is the largest stock exchange in the world. Or for example, Nasdaq is another stock exchange. So there are several stock exchanges available. Okay, so this is the stock exchange. Then of course there are the investors. So the investors want to find the right company to invest in. And what's crucial that usually they are not able to contact stock exchanges directly, and this is why broker firms came to be. So investors use broker firms that have the ability to buy and sell shares present on the stock exchange. So this is the simplified ecosystem as far as stocks, stock exchanges, broker firms, investors and companies are concerned. Nowadays, you don't have to contact these broker firms in person because you can access these services online. So usually these are online platforms with which the investors can buy or sell the underlying stocks, shares and bonds of given companies, governments and so on. Okay, what's crucial that if we consider, for example, the stock price of Apple in the past 20 years, then we can come to the conclusion that there is a fluctuation associated with every single stock as far as the price or the value is concerned. And you may pose the question why. So why are there these kinds of fluctuations? And the answer has something to do with supply and demand. So if we plot the stock price, so capital ST is the value or the price of the underlying stock, and of course we have the time on the horizontal axis, so we can see that the stock prices are usually very similar to a random walk. So stock prices rise and fall due to the fluctuation of supply and demand. So if more investors want to buy a given stock, then its market price will increase and vice versa. If more investors want to sell a given stock, then its market price will decrease. So the fundamental driving force behind stock prices fluctuations is supply and demand. Okay, let's talk a bit about why is it good to own a stock. And there are two reasons. The first reason is that there may be growth in the value of the stock that can be realized if you sell the underlying stock. By the way, stocks are considered to be risky investments. We are going to talk about the capital asset pricing model, volatility, standard deviation, and we will come to the conclusion that owning a single stock is quite risky. So usually we don't own a single stock, we own several stocks. That's called a portfolio. But anyways, we are going to talk about it in the coming lectures. What's crucial that if we consider Tesla stock prices, then you can see that if you buy Tesla stocks back in 2017 and you sell your Tesla stock in 2021, then of course you can make a huge profit, because back in 2017 the price of the Tesla stock was approximately $60, and in 2021 the price of the Tesla stock has been approximately $900. So you can make a huge amount of money by the growth in the value of the underlying stock. And the second reason why it is good to own a stock has something to do with dividends. So these are payments paid out every quarter or every 6 months to the investor or the shareholder. By the way, the amount of dividend usually depends on the profitability of the given company. So the more profitable the given company, the more money you will get as a dividend. So of course this is why it is absolutely crucial to an investor to analyze the underlying company and the underlying stock, because of course you can make a lot of money with a given stock if the underlying company is successful in the sense that it is profitable. The more profitable the underlying company, the more money you will get by dividends. Okay, and we have been talking about that stocks are quite risky. So how to measure the risk of a given stock? And it has something to do with volatility. So statistical measure of the dispersion of returns for a given security, which is the amount of uncertainty or risk about the size of changes in the value of a given security, such as a stock, a bond, or any other security. We can measure volatility with standard deviation or variance between returns of the same security. Higher the volatility, the riskier the security. So this is why we can measure the risk of the underlying stock with the help of volatility, and volatility has something to do with standard deviation. So this is why we are going to use these kinds of statistical measures such as standard deviation and variance in order to analyze the underlying stock as far as profitability is concerned, as far as risk is concerned, and so on. In one of the coming chapters, we are going to talk about the capital asset pricing model, and we will come to the conclusion that with the help of the beta value, we can approximate volatility, which means that we can approximate the risk associated with a given stock. So these are the topics we are going to consider in the coming lectures. In this lecture, I just wanted to show you a big picture as far as stocks are concerned. Thanks for watching. In this lecture, we are going to talk about